Initial public offerings or IPOs from GCC countries represented 90% of all Middle East and North Africa IPOs in the first half of 2014, according to a report from Ernst & Young. GCC firms raised $2.26 billion from 10 IPOs, which was 14% and 67% higher in volume and proceeds respectively than in the first half of 2013. Saudi Arabia led the GCC IPO activity in the first half of the year with 4 IPOs, followed by the UAE with 3, Oman with 2 and Qatar with 1. The MENA IPO market continued its recovery to end the first half of the year strongly, according to EY's MENA IPO update for the second quarter of 2014. There were a total of 16 deals raising $2.4 billion in the first 6 months of the year, an increase of 14% for both volume and proceeds on the same period in 2013, and the highest amount of capital raised in the first half since 2008. In the second quarter of 2014, IPO activity in the region picked up pace, and there were 11 IPOs raising $1.1 billion, a 129% increase on the previous quarter and a rise of 22% compared to the second quarter of 2013 by deal numbers. Dubai's retail and hospitality sector is expected to experience continued growth. However, recovery in the commercial sector remains slow, constrained by high vacancy rates. That's according to the new report by JLL. According to JLL's Dubai Real Estate Markets Overview report, although the continued economic growth in the emirate has improved sentiment and generated demand for commercial space, high level of both vacancy and future supply continued to constrain the market. As per the report, despite the vacancy rate dropping from 31% in Q2 2013 to 25% in Q2 2014, there are pockets of shortage that have resulted in major occupiers seeking to have new space built for their requirements. Furthermore, according to the head of research at JLL, there is a gradual transformation of areas that were originally meant to be commercial to residential units. One such area is Business Bay.
It's all down to quality, the quality of the building, and the tenants are all looking for the same things. They're looking for a high-quality building in single ownership in a good location, and there are not that many buildings that match all those criteria. So a lot of the space that has been built over the last few years is poor quality in some way or another. There's not sufficient parking, or the property management is not very good, or the layout is not good. I think what we'll definitely see is those buildings staying vacant for a long time. And at some point, some of those buildings are likely to be maybe not demolished, but probably reconverted into other uses, particularly in areas like Business Bay. A lot of the buildings in Business Bay were originally designed for office use. The Business Bay is now developing as a more popular location for residential. So we're finding a number of those buildings are being converted into residential. So I think that's a trend we'll see more of in the future.
Additionally, the report suggested a positive outlook for the Emirates retail and hospitality sector. According to the report, the stable hotel occupancy rates at 85% during the year to May 2014 and the decline in retail vacancy rates to 8% in Q2 2014 reflect the positive sentiment ahead of the announcement to develop Mall of the World.
Well, what we can see really is it's the other way around. It's not this project impacting on the market now. It's more that the market now is impacting on this project. So the fact that there's confidence in the market has resulted in this project going ahead. So basically, it's a boost of confidence for the market, both hospitality and retail. Both those sectors are growing. There's a strong demand in the retail market, and the hospitality market is one of the strongest performing in the world. Occupancy rates of over 80% and a very high average daily room rate makes Dubai a hugely successful, a hugely profitable market.
Etisalat Group has announced its consolidated financial statements results for the first 6 months of 2014, with an increase in consolidated revenues and subscribers both in domestic and international markets. The company reported strong consolidated revenues during the second quarter of 2014, which reached 12.6 billion dirhams, a 27% increase from the same period last year, which was boosted by the acquisition of Marak Telecom earlier in May. The net profit after federal royalty for the first half was 4.5 billion dirhams, an increase of 19% year-on-year. Additionally, Etisalat's aggregated subscriber base grew by 27% year-on-year to reach 182 million subscribers by end of June 2014. Commenting on the results, His Excellency Isa As-Suwaidi, the chairman of Etisalat, stated that the key development for this quarter was completing the acquisition of Vivendi's 53% shareholding in Maroc Telecom, which are a great value to Etisalat and its shareholders. Flydubai, in a statement released yesterday, said that it is continuing to operate flights to Ukraine just days after the shooting down of Malaysian Airlines flight MH17. The shooting down of the commercial passenger jet has raised safety fears among a number of airlines, including Emirates and Air Arabia, who immediately suspended services to Ukraine on Thursday. The airline confirmed that flights to Kiev and Odessa are currently operating to schedule, although flights to Kharkiv have been cancelled until further notice. The airline's services to Donetsk also remain suspended. Flydubai did, however, cancel its Friday Dubai to Kiev service last week. The UAE's General Civil Aviation Authority issued a directive on the same day, banning all UAE airlines from flying to Ukraine. The directive has since been altered to permit flights to Kiev and Odessa. Other airlines have moved to highlight they do not fly over areas of Ukrainian airspace, including Etihad Airways and India's Jet Airways, both issuing statements over the weekend.